All right, how's everyone doing? Paul6 here, bullsonwallstreet.com. Mentorship session early in the morning. I'm thankful that all of you guys are getting up Sunday morning, joining here for the mentorship session. Let me know if you can see my screen. You should see the October meltdown outline here, what we're going to talk about today. And you should be able to hear me okay. Okay, good. Looks like everything's good here. Perfect. All right, so today we're gonna talk a little about how we trade these, we'll call it a meltdown. I don't wanna say bear market because technically the definition for bear market is not what's happening right now. So but I think we're teetering right on that level, but not there yet. So we'll just call it the October meltdown, and October is a common month for this type of thing to happen. Let me ask you guys a question. How many of you, because I know some of you are newer traders, for how many of you is this the first time you've been through something like this? Or we'll even call it the second time, because we did have something similar back here earlier in the year. But outside of that, we haven't had moves like this in a really long time. All right, Petro, looks like it's your first time. What's going on, everybody? By the way, Metin, if I'm pronouncing your name right, John, Rosselli, Kamal, Robert. Um, Good to have you guys here. Wow, a lot of first timers. Okay, so second time for John. Yeah, so second time for Sohei. So I'm sure the first time was early January. So it is really important, guys, that you trade through these periods. I wouldn't necessarily say, yeah, we would definitely count Brexit, Petro. And those of you who were trade report members way back then in 2016 know that we traded through that pretty good, and that was a really quick move down, 3 or 4 days. But then the period coming out of that ended up being one of our most profitable periods in 2016. We'll talk about that a little later as well. Like as swing traders, it's not always a consistent month after month we make. If you're going to make 30% a year, it's not like you're making 3% or 4% every month. You go through periods where there might be a little drawdown, then you crush it. It might be a break-even period, and then you crush it. And it's really important for us to, one, know those periods to really get aggressive and trade well. And two, what I was alluding to earlier, which I didn't finish, is during these kind of really volatile periods, you need to get in protective mode and basically not lose too much. And we've come out of this period really well. So not only did we not get hit by this, but as we've gone through this period, I think we've traded it pretty good. You want to try to beat the market, first of all. The market's down about 10% right now. If you're losing less than 10%, that's really good. If you're losing only 1 to 2%, that's fantastic. If you're break even, that's even better. And if you're actually making money through this period, obviously that's icing on the cake. And we're actually at that spot right now where we've actually, with trade report alerts, we've actually came out profitable through this period. And there's some things we're going to talk about, and you'll kind of understand what I've been doing as we talk about these things. So, okay, it looks like a lot of you are newer traders, and it's your first or second time. I don't see anyone here saying, "Yeah, I've been through this a million times." But when you start trading long enough, you will have been through this a bunch of times. It happens 2 or 3 times every year. That's why you'll notice my report videos, no matter how bad or how crazy the market is, I basically sound the same every day because this is really no big deal to me. I've seen this happen so many times. Okay, so let's talk about this October meltdown, and let's start with the beginning before it even happened. And excuse me, guys, my voice is a little scratchy. I'm coming off being sick, but bear with me. We'll get through, hopefully get through this whole thing okay. But let's talk about the beginning here. Now, if you guys remember, and if you weren't a trade report member yet, I know we have a number of new members, but it's only about 3 weeks ago now. So most of you were with this in this period with me here. So let's go back, rewind a little bit before we even got to the market sell-off. So I'm going to actually pull this chart back. So let's pretend it's 2, 3 weeks ago. We have no idea the market is going to melt down. We just see SPY at all-time highs. All the news is wow. The market is great. Everything's fantastic. You turn on CNBC, we're at all-time highs. You go on Twitter, all these guys are talking. All the bulls are out there talking about market breadth is great. The market is great. all the worry birds or all the bears are getting trapped. Whatever the talk was. Actually, and during this period, we were actually getting really cautious. And those of you, I mean, most of you guys were here. What were we talking about? Let me see the notes here and see if you guys are still on top of it. What were we talking about that was concerning us during this period? So while everybody was bullish here, why were we getting really conservative? And I see Petro, you've got a good answer. Benit, you've got a good answer. Kamal, you've got a good answer. Great. So you guys are on top of it. The main thing is market breadth, and all good. Good. I'm glad I've hit this home. You guys all know it, and I'm going to beat it to death again today because it's the thing we have to be paying attention to. So I think of when I look at the market, first I do a surface level kind of analysis. I do this every weekend, and I'm doing it on a daily basis, but especially over the weekend, heading into the week. I do this every week. I take a look at the market, and you see this in the report. I don't start with the stocks I like. I never do that. I don't start with the trades I'm in or anything like that. I always start with SPY is doing this, IWM is doing this, and are we bullish, slightly bearish? What's our bias? You hear me doing that every day because we start with the market. And I start on a surface level. First of all, I'm just looking at the market trend. So obviously the market trend was very good hit in SPY here, and we were at all-time highs. But then we have to look at it on a deeper level. And a lot of stuff is hidden that we don't see here. And you guys are great. You already have pointed out a lot. That makes me happy that the stuff we're talking about every day is sinking in. So that's really good. But I mean, think about it like if you're buying a used car. You might see a car, looks great, paint job is great, you know, looks like it would drive well. You look at the interior, everything looks fine, but you would never buy the car like that. You're going to test drive it. You're going to check the engine. You might even bring in a mechanic to take a look over at it and kind of check it on a deeper level. And that's what market breadth is. We're kind of going under the hood and looking at the market at a deeper level. And you guys already pointed out that's fantastic. Petro pointed out IWM, and Benit pointed out T2108. And this relates to what all of you guys talked about here in market breadth. Market breadth was not good. So there are many different factors we can look at. I look at things like new highs versus new lows. Are we seeing a lot of breakouts? Are we seeing more breakdowns or breakouts? These are all things in a booming market. We'd expect to see more new highs and new lows. We'd expect to see a lot of breakouts. We weren't seeing that. My own stocks, the stocks on my watch list, they were not seeming to keep pace with the market. I wasn't finding a lot of great stocks to trade. And on top of that, two things you guys mentioned, IWM. Remember, we were really hitting this home that what's wrong with IWM? So look at in August, September, we were hitting new highs, much higher than February here. So the trend was like this, and here the trend was like this. Now, let's take a look at what IWM was doing during this period. IWM was going down. So while SPY was going up like this, IWM was going down. So that was a concern because we expect in a booming market, we want to see IWM at least keeping pace with SPY, and we were not seeing that because this is a broader index. It's 2,000 stocks rather than 500, and the S&P 500 is not equally weighted. So it's not like they take the 500 stocks and each one is worth the same amount. I think Apple alone, someone can correct me if I'm wrong, but I think Apple alone makes up 7 or 8% of the S&P 500. If my number may be off a little bit, but the point remains that that one stock is a large chunk of SPY. And then if you take the top 8 to 10 stocks of those 500 stocks, they make up over 20%. I think the number is closer to 27 or 28% of SPY. So it's very top heavy, whereas the Russell 2000 is more spread out. So it's giving us a better indication, and that was lagging. And then now let's take a look at SPY again. Again, if let me pull this back a little further. SPY, let's take a look at the previous peaks, is going up like this. Now let's take a look at the T2108. And what the T2108 is measuring is stocks above their 40-day moving averages. Now, when the market is at all-time highs, we expect a lot of stocks to be above their 40-day moving averages. And look at what was happening to the T2108. And this, by the way, this T2108 indicator is specific to TC2000, but other charting platforms will have something similar. If you go into stockcharts.com, a free site, they use the 50-day moving average. They don't call it T2108. It's just stocks above their 50-day moving average. You can do a search for that chart if you don't use TC2000. But anyway, we would have expected, if the T2108 was doing what SPY is doing, we would have expected it to be going up like this, but it was not doing that. It was not even going sideways. It was going down, less and less stocks. And before that big sell-off even hit, T2108 had gone from 71 down to, the upper 50s, and it should have actually been around 80. So again, that was a negative divergence, telling us we're not seeing good market breadth. The overall universe of stocks are not keeping up with the all-time highs we were seeing in SPY. So these are two of the factors. There are a number of other factors, but we'll just hit home on these two that were concerning me about the market, concerning us about the market. So if you remember here, while we were at all-time highs, we were actually winding down our positions. I think we got stopped out of one or two. We took profits in, I think, three or four. And we can actually look back here. I've got the statistics up. So you can see here, we took a few losses. We had some nice wins here in here. But we were winding our positions down. And even though we were seeing a lot of setups, we were not adding any position. So when the meltdown started, we were only in one position. So we timed this thing really well. Now, on top of that, timed it in the sense that we didn't get caught, and most people were getting caught. So, and you're going to be really surprised if you pay attention to market breadth, you're normally not going to be caught by these kind of moves, because there's always someone in the know. Those big institutions, they know what's happening before everyone else does, and they're already pulling out of these things, and we start to notice that if we dig deeper into what we're seeing. So, February, we didn't get caught. This time we didn't get caught. We could go back here. The last time I got caught by a move down was actually Brexit in July 2016. And, even that, I didn't get caught that big, but I think I was in three positions at that time. And that one was one where we knew the vote was coming, but I don't think anybody knew the vote was going to go in the direction it did. So that was a little different. But generally, almost all of these major sell-offs, and let me pull this back here and let's just take a look at some history. We had that big sell-off October 2014. We had this big sell-off. This was the Greece bankruptcy in 2015. We had two sell-offs in 2016. And then we had Brexit right here. And, through all these, and you can go back to the trade reports, going back, all the way to when we started in middle of 2014. The only one we really got caught was Brexit. Other ones, we could see them coming a mile away, and that's because we do this analysis. So I want you guys to remember that. Don't get caught up in all-time highs. Always look at under the surface. Always pay attention to market breadth. And now, so we were looking for divergences while we were at highs, right? So this time we're going to look for a different type of market breadth. So as the market is starting to tank now we want to see if as the market is tanking, do we see market breadth improve? That would be our signal that we can get less cautious and we could kind of ride a trend going up. Until then, our bias is going to be to the downside. And I think I'm skipping ahead here. We'll get to that in a second. So, number one, calm before the storm. This is what I was talking about here. How before the meltdown even happened, I wouldn't say we predicted it. No, we can't say, okay, yeah, we thought the market was going to go down 10%, but we did know it was time to be cautious, and you see why. It's basically because of market breadth, and you guys have done a good job identifying that yourselves. Now, um, after that initial calm before the storm, we have the initial meltdown. And that initial phase, you want to be very cautious. And let me ask you guys, I mentioned it in the report a few times. When that initial meltdown happened, we were barely trading. So we were trading really infrequently. But what were we doing to prepare while this initial meltdown was happening? And when I say initial meltdown, I mean, this move here, this 1, 2, 3, 4, we'll call it a 5-day move. Uh, what were we doing? We weren't trading, but there were some stuff we were doing to prepare for that next move down, which we're in right now. Petro, you're half right. Building watch lists, right? How are we building these watch lists? So Joseph, you're right. Petro, you're right in a sense. Getting a short list ready, building a watch list. We are preparing. We're getting ready. We're building these lists. But what we're doing and what we still should be doing. Good job, Jerome. You got it right. Relative strength and relative weakness. Sector analysis too. We should definitely be paying attention to sectors, and that relates to relative strength and relative weakness. Throughout this whole period now, we're basically paying attention to narrowing our approach down, basically paying attention to the indexes themselves, and you guys know we're short 2 of the indexes, and then some major stocks. You shouldn't be watching too much right now. But while this is happening, you build the relative strength and the relative weakness list. That's what we do during this move here. Now, we build these lists and we don't know which one we're going to use. So we're just preparing. We're in that initial meltdown phase. We know there's not really a lot for us to do during this period, but we're waiting for that second move, and that second move always comes. In February here, it was a bounce here before we had another failure. Post Brexit, the secondary move came quickly, and unlike this move, which was a secondary move down, post Brexit, let me pull that up real quick here. We'll go back to 2016, and you can see here, post Brexit, it was a move back to the upside. And we traded this period very well once we identified that the sell-off was over. We went to our relative strength list, and at the time it was biotechs and semiconductors, and we did very well during this period. And that's what we're doing now. We're making that relative strength and relative weakness list. And when we get to point 6 here, we'll actually go through and go through some stocks that are relative strength and relative weakness and how we find them. But just know right now that initial meltdown period, relative strength, relative weakness. In the report, I was putting out some stocks that were relative strength, relative weakness. NVIDIA, relative weakness. Square, relative weakness. Relative strength. Alta, which we did take a shot at and got stopped out. My mind's blanking now, but there are a number of other relative strength stocks. Tesla is actually relative strength right now, although I'd be a little hesitant to trade that with all the news that comes out on a daily basis. Coles is showing relative strength, and we'll go over those in a second. But yeah, building the relative strength and relative weakness list, and we went to a relative weakness because we saw the bounce here failed. So once you start seeing, you get that initial bounce, now we're trying to assess, okay, is the market going to go back on trend? And if it goes back on trend, great. We go into our relative strength stocks and start trading the Altas, the Coles, and whatever else is holding up. Cyber was holding up for a while, and some other stocks. We went to relative weakness, and rather than trading specific stocks, like I could have traded NVIDIA, that was on our relative weakness list, and if we had, NVIDIA crashed pretty hard as we expected it would. But I went with the inverse ETFs, and if you're trading the leveraged ETFs, you aren't going to find a lot of stocks that beat those. So like SQQ, and we traded the inverse ETFs, and if there's anyone, oh, good job, Robert. Yeah, my mind was blanking. Lulu, of course, Orly, of course. Those are both on our watch list in the report. Thanks for that, bailing me out there because my mind's blanking right now. It's early. But yeah, we went with SQQQ and SPXS, and you can see how strong they've been, and hopefully they continue. We're playing for a bigger move right now. But if anybody, I've tried to explain it in the reports, but if anybody has any questions about what these inverse ETFs actually are, let me know, or how to trade them. But essentially what they are is they're 3 times the leverage of the underlying ETF. So if let's just take a look at TQQQ, which mirrors the Qs. So if the Qs are down 2%, TQQQ is going to be down around 6%. You can see here it was down perfect number here, 7.77%. That means the Qs were down probably around 2.5%, a little more than that. Yeah, they were down a little more than 2.5%. So it's going to triple, pretty closely triple. If it was up 2.5%, the Qs, then TQQQ would be up over 7%. And so if we're looking at TQQQ here, now ideally I like to just short it directly, but most brokers are not going to let you short these things. Interactive brokers oftentimes will if they have shares available. But the other easy way to do it is just take the inverse. So it's just going to be the inverse of TQQQ is going to be SQQQ. And what we can do then is instead of shorting it, we go long this thing, and it's going to mirror kind of, I don't know what the correct terminology would be, opposite, but it's going to invert what the Qs are doing 3 times. So you can see it was, so TQQQ was down over 7%. SQQQ, I'm getting a little mixed up here, was up 7%. So that was good for us. We were up 7% because of that. So you can just use the index ETFs, and very few stocks are going to beat these. So like Nvidia was down 4%. So we were better off taking SQQQ, which was up for us 7%. So hopefully maybe I bungled that up a little bit, but hopefully that makes sense for everybody. Same thing with SPXXS, same thing. It was up 5% for us, which means SPY was down probably 1.5% on Friday, 1.7%. So that's the idea here behind the inverses. So we're net short the market now, and we're also got BABA here, which is a wonderful pattern here. It keeps failing at the 9, which is what we want to see in these downtrends. The problem for us is it does report earnings later in the week, so we are going to have to get out of it this week. Hopefully we get a nice flush before that happens. We'll see. It's just barely below our entry point right now. So where was I here? The initial meltdown. So you get to that initial meltdown, and then you're looking for whether we're going to get that continuation, or is it going to be a dead cat bounce, or what you can call it a bull trap. And you'll see a lot of traps in these markets. And what I mean by traps is it gets everyone thinking the market is going one way, but it truly is a trap because it hasn't really broke in any direction. That's why we haven't been fooled by this. If you listen to pundits and people on Twitter and even respectable traders, a lot of them were calling for bounce plays in here and bounce plays in here, and we didn't bite on that because we're waiting for market breadth to improve and the market to take out resistance levels. That's the only way we're going to start getting aggressively long, and it never did that. Market breadth did not improve. It was just going with the market, and we never took out the 9 here. We never took out these old highs. We haven't taken this old high yet. We haven't taken the 50-day out yet. So until that happens, these are just kind of traps here. Everyone starts thinking, okay, we're going to bounce here, and we're expecting the failure. Now, we're not married to our thought process. We'll turn on a dime, but we have to have evidence of that. And for us, the evidence right now is going to be break of the 9 here, break of the 200-day moving average, improvement in IWM, improvement in the Qs, The stocks we watch, we want to see them start to improve. When all of these things start to come together, T2108 starts to take off. When we start see these things start to improve, then we say, okay, now we'll take 3 or 4 longs and see how they do. But until then, the bias is still to the downside. Until we start breaking these levels on good market breadth, I am still going to have that opinion that there's a good chance we're going to test the April low, which would be 255 here on SPY, or the February low, which is going to be around 253, and then we'll reassess until that happens. Now, that being said, if the market does pull back really hard and gives us a rubber band type bounce setup where we think we could get a powerful snap that might not be reversing trend, but could give us a good percentage gain before going down again, I will take a bounce play like that. But we weren't in that position yet. These weren't really good snapback positions. This was not a good snapback. A lot of people were calling a bounce right here, and we didn't bite on that. I know just from trade report members, I think part of it is you guys hear all these other people that might get in your head, but I got a ton of emails 2 days ago asking me, should we be pulling our shorts off? Should we be playing the bounce here? And my response would be nothing has changed until we break these levels. Once we do break these levels, obviously then we can change. So we will adapt to whatever we're seeing, but we haven't seen anything worth adapting to at this point. Okay, so we had that bull trap here, or dead cat bounce, secondary move down, and that's where we are right now. We're in this secondary phase down that for me would last until we test these levels, and then we'd look for even a third phase down if that's going to happen. We don't know. We don't know if any of that's going to happen yet, but that is the bias right now. And this is basically where we are at this point. Now, one other thing I want to point out is be careful of intraday action that leads to bull and bear traps. What I mean by that is, and I'm going to pull up let's see if I can go back and pull up the intraday. First of all, you guys, while a lot of us day trade, I day trade as much as I swing trade. A lot of people don't know that because I do, publicly I'm swing trading, but I do a lot of day trading as well. But my time frame for my swing trading completely ignores intraday action. All I care about for swings, especially in these markets, is the open, the close. The only time I'll really pay attention to the intraday action is if we're really beaten down and we're seeing strength intraday, or we're taking out a key level. So, if intraday we broke out over 273 and we're breaking the 9, I would pay attention to that. But in general, intraday action doesn't mean a lot to us. Let me pull up the 5-minute here and illustrate this. So let me actually go back here and see where we're at. Okay, I can't remember if it was 25th or 24th, but there were traps on both sides here. So on the 25th, so maybe it was the 24th. Yeah, it was the 24th. So on the 24th, we started tanking in the morning, and you see a lot of people shorting. A lot of people started shorting as swing traders here. We were a little too beaten down to be shorting at that point, and if you shorted here, you're probably going to get taken out intraday. And then when it started to look like we were going to bounce, that failed as well. So if you start following the intraday action, you're going to think, okay, I got to short here, I got to go long here, I've got to go long here, I've got to go short here, and you're just going to get chopped out. Really just pay attention to the open and the close. All right, we've covered a lot here. We've basically recapped what we've been doing. So hopefully you have a better understanding now. We do this every day, but as we're doing this on a daily basis, we get really zoned into what we're doing. So hopefully now stepping back, you can see like over the last 3 weeks, exactly what we've been doing. We're gonna get to relative strength and relative weakness stocks, but let me see, you guys have some questions here. Okay, Metin, if I'm saying your name right. Europe, we can't trade ETFs anymore. We have some CFDs. I can't trade your list. Can you tell me some other products? Honestly, you'll have to look into that. You could take stocks that tend to mirror the market. I think that would be your best bet. Look for stocks that tend to move with the market, and maybe trade those. Um, if you can't trade ETFs, I'm not sure if anybody else has some recommendations. Send them my way, and we'll get our European friends here that information. The inverse IWM, that would be TZA. So, so the one that I haven't traded yet because it's just been so beaten down that I was hesitant to, although it would have been a great trade. TNA is the IWM triple leveraged long, and then the short is TZA. So TNA, TZA. Okay, can you give us the symbol of the 3 times inverse SPY? Yeah, that's the one we're in right now. Sammy, that's SPXS. And we're in this one right now. Can you show us list of buys last time? Yeah, I haven't updated it. Metin, why don't we do this? The next, I think 2 mentorship sessions ago, we did a review of all the trades. We're heading into the end of the year, and I'll do another review, obviously, as the year ends. I've been a little lazy here. I need to update this. We're up since this 23%, and especially once we close out these trades. But I'll get this updated shortly. For the potential bounce play, does oversold indicator play a factor into your decision? John, which indicator are you talking about? Is it stochastics, Bollinger Bands? Yeah, I am paying attention to that. Now, those bounce plays are really quick trades. You just wrote, Vineet, you just wrote Tesla intraday. I'm not sure what your question is about Tesla. How do you define the size of your positions? Okay, so when you're deciding the position size, I think that's what you're asking, right, Rosselli? How do you decide what position size you're going to take? The first thing I do is I know where my stop is going to be. So let's say you have a $100,000 account. I know a lot of you guys have varied accounts. Some of you guys have bigger accounts than this. Some of you are trading $5,000, $10,000 accounts, whatever it is. Let's say you're risking 1% of your account. What I mean by that is if you get stopped out, your loss is going to be 1%. So if you have a $100,000 account, you're never going to risk more. You don't want to risk more. We'll go a little higher sometimes, maybe 1.5%, but let's just say $1,000. You don't want to risk more than $1,000. If it's a $10,000 account you're trading, you don't want to risk more than $100. Okay? So you have to factor that in when you are position sizing. So let's go back to the 100,000 since that's what we use. Let's say, to make it easy, let's say the stock is $100 and you are going to place your stop at 99. So you're using a 1-point stop. If your stop got hit, the stock goes down 1 point, where would you lose $1,000? And that would be if you had 1,000 shares. Now, if you're risking 2 points, you would take 500 shares. So that's how we're calculating our position sizes. So let's say you see me take, with a 1-point stop, I take 1,000 shares, but your account is 10,000, you should be taking 100 shares. Okay, John, Bollinger Bands. Yeah, you can use Bollinger Bands if it gets really extended to one side. Now, that shouldn't be the be-all or end-all. It should be a guide. And then you have to look at price action. How did it get there? Is it really steep going down? Did it just kind of slowly step down? Then we want the steep moves down. So you can use it as a guide. It can be a helpful tool, but I wouldn't base everything on that. Jolson, when it comes to swing trading, is it best to deal with ETFs? I mean, ETFs are great. We're using them right now, but I think probably 80% of my trades this year have been stocks and not ETFs. If you go through the list here of the trades, Most are actually not ETFs. I like to use ETFs during these periods because there are very few stocks that are going to beat the ETFs because the ETFs are so leveraged. Do you use ATR when deciding your stop loss? In a sense, I do. I am thinking about the volatility of the stock, but I don't use the ATR measure. But I am looking at, okay, the stock tends to move two or 3 points a day. I know I have to factor that into where I'm placing my stop. Okay, all right. Let's get back to the list here. We already went through the index ETFs, the ones we're trading. That is, let me clear this out. That is for SPY. We are using SPXS. And again, my mind is blanking. If you guys can tell me what the long version is, that'd be great. For the Qs, it is TQQQ and SQQQ. And for the Russell, it's going to be TNA and TZA. And again, I'm forgetting this one here. If anyone has it, let me know. All right, let's get to relative strength and relative weakness. I'm going to show you guys. Oh, there. I think SPXL is the double leverage, not triple leverage. But let me check. Oh, it is triple. Oh, perfect. Okay. Yeah. So thanks a lot, Petro. It's SPXL. So SPXL. So use these three. You don't even have to be looking at stocks right now. You could just successfully be trading these for the market moves at this point. Okay, relative strength, relative weakness. Let's talk about a few ways to assess relative strength and relative weakness. One thing you can do is just go through your watch list and look at stocks that are beating what the market is doing. So what I have here is a 2-week filter here. So basically, the last 2 weeks here is when we've had that meltdown. So as this meltdown has been happening, what stocks in my own watch list have held up well? So we can see here, Tesla obviously has. I'd still be hesitant to trade Tesla because of all the, on a daily basis, there seems to be news, and now it looks like there's going to be another investigation. So I'd be careful with Tesla for swings. Twitter has been very strong. You guys hear me talking about Brazil every day. Brazil has been very strong. You look, while the market has been doing this, Brazil has been going straight up and consolidating here. Coles has held up well. Now I know it's pulled back here, but relative to the market, now remember, SPY is below its 200-day moving average. Coles is above it. So let's take a look at SPY again. SPY way below its 200-day. Coles has held up well. Even though it's pulled back, it's above it. So I would call that relative strength. Alta, a lot of relative strength here. Not only is it above its 200, it's above its 50-day as well. Very strong here. Restoration Hardware, I really don't like that one. Ralph Lauren has held up very well here above its 200-day moving average. Urban, you're going to find a lot of the retail stocks have held up pretty good. Apple is doing fantastic on this pullback, whilst a ton of the tech stocks have just been getting crushed. I mean, let's just off the top of our heads, NVIDIA getting crushed, Team getting crushed, Square getting crushed. Look at Netflix getting crushed. And Netflix had great earnings and it's still getting crushed. Google has been getting crushed. But look at Apple. Apple has held up really well, way above its 200-day moving average, just barely below its 50-day moving average. So Apple is definitely a relative strength stock. So that's one way you can do it. The other thing is you can take the same 2-week filter and filter out the stocks within the indexes. So let's go to the NASDAQ 100. And we were running the same filter. And CDNS, look at that. It's near highs, obviously a relative strength stock. PayPal has held up really well above its 200-day moving average, near its 50-day moving average. WBA has been really strong. Starbucks, really strong. Dollar Tree, not so good. Alta, really strong. We can do the same thing for the Russell. So here's uh, the Russell 1000. Again, Tesla, Twitter, ABX, which is a gold miner, very strong. Burlington Coat Factory, or Burlington Stores, very strong. Look at this. We were talking about retail has held up really well. That's a sector to be paying attention to right now because that sector has held up well during this pullback. And you can see Burlington here. It's near all-time highs. Morningstar. Wow, I wasn't even paying attention to this one, but yeah, above its 50-day moving average. So this is a good way to do it. You can quickly find stocks, that are beating the market by doing this. And at the same time, you can go to the bottom of this list, and actually instead of scrolling down, we've already scrolled. Okay, you can go to the bottom of this list and see stocks that are doing worse than what the market is doing as well. You can see NVIDIA here is way at the bottom. It's 981 out of 999 in the Russell 1000. So obviously that's a good reason for it to be on our relative weakness list. So build these relative strength, relative weakness lists anytime the market is pulling back like this. And actually, I'm doing this all the time, even in good markets. I want to see which stocks are beating the market and which stocks aren't. But it's especially important in these markets. Okay, so if you have any questions about relative strength, relative weakness, let me know. Signals and key support levels. I think we've kind of talked about this as we've been talking about the market. Again, we're looking for key levels. How does price action react if it pulls back to these lows, if it breaks a 9, if it breaks a 50? These are all levels we should be watching, and not only watching, but seeing how price action reacts at those levels. Okay, one other concept to think about, the reversion to the mean. So, when we're thinking about these bounce plays, this thing is not going to go in a straight line. At some point, even if eventually we're going to hit, all the way down here to 230, go all the way back to, early 2017. Let's say we can predict the future and we know 3 months from now we're going to hit 225. Even if we hit that 225, it is not going to go down in a straight line. These bear markets have powerful bounces, and actually the biggest percentage gains on a daily basis that we see are usually not in bull markets, they're in bear markets. You get these very powerful snapbacks before the next move down. We saw many snapbacks here, not really that powerful, but you'll be surprised at how strong these things can be. I mean, look at just 2018. We've been, for the most part, in a bull market in 2018, but our biggest one-day gains were actually during this sell-off here, and now during this sell-off here. We had a big one here and a big one here. So we see these reversion to the mean type trades. So if this thing gets very extended, we would expect to see some kind of snapback. So always be paying attention to that. And then when it gets too extended to the upside, start looking for that snapback to the downside to potentially short. So always be thinking about that. And then, if we do start to improve, look to see if we start making lower highs, and if we start to make higher highs as well. That would be another indication that the market is improving. But when we bounce and we don't make, if we make higher lows, that obviously is a negative. Okay, one last thing I want to leave you guys with in our discussion about the bear market right now, and then we'll open it up to some more questions. I have this little article here, and I've been to, in the last couple of weeks, I've been to 2 conferences. Kanal was at them too, Traders for a Cause in Vegas, and Trade Ideas out here in San Diego, where I am. And a lot of hedge fund managers and a lot of talk, and the market is down 0.5% right now. If we look at SPY here, year to date now, the SPY is down 0.5%. And most hedge funds are actually doing even worse right now. So I put out this little post on Instagram, and I mean it here. These guys are supposed to be the pros, right? And I know they're trading big amounts of money, and they make all the excuses in the book, but the fact remains that hedge funds are getting crushed this year. Even when the market was at highs, there were a lot of hedge funds getting crushed. You can see one was down 4.7 this month, another was down 9% year to date through October. And as an aggregate, hedge funds are losing this year. So if you are in the green this year, I know it could be frustrating, you want to be up more, but considering what the market has been doing this year, you probably want to pat yourself on the back because you're beating the pros. And in the trade alerts here, we are crushing the pros right now. Not only are we crushing the market, we're crushing the professional traders. So if you are in the green this year, pat yourself on the back. You're doing really well. And now eventually we are going to get a good trend. When that good trend comes, you'll go from doing really well to crushing it. So keep that in mind. This has been a difficult market to trade. And the fact that you are green is really a good thing, no matter whether it's 1%, whether it's 20%, 40%, wherever you are, if you are green this year, you're doing really well. Okay, so that's our lesson today on bear markets, or these corrective type markets. Hopefully you found this helpful. We have talked about all this on a daily basis, but just kind of doing a recap on the whole thing, hopefully gets the big picture in for you guys. And then the next time this happens 2 or 3 times almost every year, you'll be ready for it. Okay, let's open it up to some questions here. You can ask questions about specifically what we talked about today, or if you've got any other questions, that's fine as well. Yeah, you can use UPRO as well. There are multiple different ETFs. UPRO is another one for 3 times SPY. Is it possible that you can trade more stocks than ETFs? Metin, like I said, if you look at my trades here, I trade many more stocks than ETFs. I can't change what I'm doing just for you specifically, but when I post the reports, you don't have to go by the trade alerts. There are focus list stocks as well, and I list a bunch of stocks. So if you can't trade the ETFs, go ahead and look at the stocks that I'm listing as well. Did you cover sector rotation as it applies to the new market sell-off? Yeah, we mentioned retail, and we've mentioned Brazil right now. Outside of that, I have not seen a ton of rotation. Of course, there's rotation into gold. I don't count that. Or the big Dow stocks obviously handle these levels because they're better because of their flight to safety. But once we come out of this, those aren't the sectors we're going to go to. It's just safety right now. But in terms of real rotation, the only real things that jump out at me right now are retail and Brazil. Let's actually do this real quick here. Here's the industry indexes. Actually, I'll pull it up here. Industry indexes. And let's do the last 14 days. This will give us a quick look at what really has been leading the market. Maybe I've missed something. Education training. I mean, even though it's been leading over the last 2 weeks, it's still getting crushed. I don't see much rotation there. Tobacco is like a safety industry, so I wouldn't put much stock in that one. Discount stores, and this relates to retail, and you can see how retail has been doing very well during this period. Pharmaceuticals have been doing well. Some select biotech areas, healthcare has been doing well and hasn't really gotten hit by the market. So we could add that to some biotech related areas, specifically medical devices and healthcare. Banks are hanging in there, but still nothing really jumping out at this point. But as this develops more and more, we'll see more and more of the rotation. But right now, it's just basically fear in the market, and just about everything's getting hit. Are there any discounts available to bootcamp members? The discounts come if you do the yearly, you get 50% off. So obviously that's a great deal. And then, every once in a while around holidays, I'm sure there'll be one around Thanksgiving and Christmas or New Year's or holidays. I'm sure there'll be some discounts there as well, Peyton. Although the 50% off is a great deal if you sign up for the yearly. Okay, AMD is getting crushed, right? Yeah, it is. Uh, I entered UGLD on Friday as a hedge to the drop in SPY. Yeah, you can always use gold as a hedge. I think that's good. Um, can you elaborate between a steep move down and a slow move down? Yeah. So, we'll just draw it here. When I'm looking for a strong bounce play, I want to see a move that's basically down like this, okay? Or very little, it could be a little consolidation like this, but we're not calling this a trend. It's just like kind of a crash down. This is what I would consider a trend down if it's going like this over a period of time. Now, that doesn't mean we couldn't trade a reversal, but this would be more of a bottoming formation type move, whereas this would be a quick snapback rally that we're expecting. All right. Do the leverage ETFs lose value overnight? Yes, they do. Price decay, which is why, if you remember when I was talking about the ETFs, my preference is to trade to short TQQ directly rather than go the inverse SQQQ, because you get the advantage of price decay. So if your broker allows you to short the index, that's always the better way to do it versus the index, but versus the inverse ETF. But if you're only holding it for a month and a half, it's not going to make a huge difference. But if you're planning to hold this thing, 3, 4, 5, 6 months or longer, then you do have to take into account price decay. But for short-term trades, it's not a huge deal. Suhas, do you recommend re-entering SQQQ and SPXS if there is a dead cat bounce? I can't make a blanket statement. We have to see what happens. But if the Qs were to uh, do another bounce and fail at the 9 and nothing improves, I think that would probably be a good spot to short again. But I won't make that statement until I actually see how the price action is at that point. Uh, what's your favorite indicator for market breadth? I don't look at one. So there are a number of things I'm looking at, and I'll never base it on just one. If T2108 is giving me a signal, but nothing else is, I don't take much stock in it. But if I'm seeing multiple things aligning, I'm seeing IWM, I'm seeing T2108, I'm seeing, lack of breakouts, new highs, all kind of converging together, that's where I really start to uh, take weight in the market breadth. Okay. Yeah, Antonio, you're right. Brazil, big day, elections are coming up, which is why I've been hesitant right now to jump in, even though it looks so great. It's one of those things where they could be a news event, and even if the news goes the way that's expected, sometimes it's a sell the news event. So let's wait for that to end and then see where the trend goes with Brazil. Um, you know, if it starts to continue higher after this, there'll be a lot of room to the upside. Do you suggest taking a new entry in SQQQ? I'm always hesitant to make these kind of recommendations on something I'm not doing right now. And I get these kind of questions a lot for people who didn't enter when I entered. Um, if I were to look at the Qs right now and I was not in the short, I would feel like, wow, this is really extended right now. I'm hesitant to enter here unless we bounce and fail again. That doesn't mean it can't go down further, but the risk reward just isn't that great, initiating a short right here. How do you add the 2-week daily indicator? You basically take the same 5-day we use, and instead of the five, let me show you the formula here. And if you guys are on the new version of TC2000, I think they already have some of these settings in there. But here you can see the formula. Just change it to the amount wherever it says 5 here. This is the 5 day. If you want 14 days, change that to 14. If you want 30, change that to 30. Whatever, however many days you want. If we identify we're going up to here and that's the last 18 days, you could put 18 in here. That's parentheses, parentheses, C minus C, whatever the number is, parentheses, division sign, parentheses, 0.001 plus C5, parentheses, parentheses, multiplied by 100. With Apple earnings coming, do you think that could hurt our position as SPXS? It could impact the index, but I wouldn't trade Apple right now, but I'm not going to take off my positions just because of Apple. Since you have noticed relative strength within the sector, how would you choose stocks within the sector? You can take the sector, whatever it is. So let's say we identified we were looking at discount stores on TC2000, and you can do this on FinViz as well. Go into groupings and you can do it there. Click on this little thing right here and it gives you the stocks within the sector, and just look for the relative strength stocks within the sector. Obviously, Walmart is showing relative strength here. Costco is not. DG is kind of. Burlington, we talked about, is. So you can go, that's a really easy way to do it. And also a lot of the ETFs. So if we pull up XLF, this is the financial sector. We pull up, we can pull up the stocks that make up XLF. If we pull up XLE, which is energy, we can pull up then the stocks that make up the energy sector here and find the best relative strength stocks. What would you call the move in NVIDIA? What would I call it? A crash? Basically the same thing as what the market is doing, just to more of an extent. This would be, for me, if I was labeling these, this would be a second threat, what I call a second threat short. So after that initial move, a failure of a dead cat bounce, and then another move down is what I call second threat short. All right, Justin, you guys know this from the report. I do move stops for various reasons, although I don't move them by much. If I can use a mental stop, I will. If I'm away from the screens and I have to use a hard stop, I'll put in a hard stop. So those of you guys who are working and can't watch the screens, you should have hard stops in place. Volume does impact my decision making, yes. All right, Petro, I thought I explained this when we were going over the market. 1023, I said the bounce was not one that signifies strength. First of all, we were still within the previous daily range. We didn't break any resistance levels. We didn't close near highs. If we looked at market breadth, stocks weren't doing amazing that day. So factoring in all these things, I didn't see any indication that this was the type of move we want to be getting long. Would you consider doing a hedge trading strategy? Yeah, Antonio, you can do that. You can pit two ETFs against each other. You could take, or two stocks that are similar against each other. And basically then you're trading market volatility. Now, I'm not doing that because I am picking a direction. I think the market is going down, right? So I'm not pitting longs against shorts right now. But you can definitely do that, pit longs against shorts, and basically you're saying, I don't know which direction the market's going to go, but I expect a big move up or down. Justin, I'm not sure. So Justin's asking, though, I know we have a number of Canadian traders. Wasn't even aware that you can't get the trade alerts by text message in Canada. I just focus on the trading. You'll want to ask Kevin, probably would know more about that. So email him, and he should be able to answer that question about text messages. All right, guys, that looks like the extent of your questions here. So another great mentoring session, another less. So we're building up a library of lessons. So I keep the link of all our mentoring sessions in at the top of every report. So if you want to go back, we always start with a lesson. So this is the lesson on how to deal with corrective markets. When we, if say a year from now and you're still a member and we're in the middle of a sell-off and you want to know how we handle these, go back and watch this again, and go back and watch the rest of the mentoring sessions. Remember, every one of these, I do a lesson before we get to the Q&As. So we're building up a good library of these different lessons now. So, all right, guys, enjoy the rest of your weekend. I'm going to be watching some football here, and then we'll do another one of these. I try to do these every couple of weeks. So we'll do another one probably early November here. So have a great rest of the weekend. Happy Halloween, and I'll see you guys tomorrow morning with the trade report. All right, talk to you guys later.